if you continue this type of, increase in rates over a period of time, it then starts to make the whole model look unsustainable. And that's when you will reach a breaking point.
When something big happens in the bond markets, this is the man that I call. Reza, welcome back.
Nice to see you again, Rich.
Thank you so much for coming in. Last minute, I called you yesterday and said, look, Japan, we've had something go on there, as well as the US downgrade. So what is going on?
Well, I mean, people are focusing on the credit risk of governments at the moment. So obviously there's a lot going on in the world. So last night, people were a little bit concerned about the latest Japanese bond auction. It had less demand, less coverage than we've seen in the last 10 years. So people are particularly concerned about the long end. So what we call the long end, the longer dated maturities, the kind of 30, 40 year. And so,
as opposed to the short end, I'm guessing?
As opposed to the short end. And so, that's also kind of fed into the markets. Kind of reaction rates have risen, slightly on the short end and more on the, the long end. So the 40-year has gone up by, say, 0.5% over the last month or so, and run up to that.
Can you just run us through exactly what that means? Why do rates move or yields move differently at the short end as to the long end?
Yeah, so it's the perceived risk. And so now the market dynamic is that there is a focus on credit risk of governments. And so the long end obviously means that, there's greater risk in holding bonds for a longer period of time. And so people, market participants, investors need to feel that there is a good, solid strategy from central banks in order to, in terms of their purchasing policy, to maintain the lower rates or demand in the market for the bonds,
right?
They need to look at the fiscal situations of economies, and so that's a little bit in flux at the moment. And so basically, there's a focus on risk of governments, being able to pay back their longer dated debt. So that's why the longer maturities are, seeing a little bit more of a higher rise in rates because of the higher risk.
And obviously, in the short term, you're guaranteed to get your money back.
Yeah, I mean, basically, unless something major implodes, basically that's the case. I would say that this is actually the new type of relationship we're seeing in terms of investors' thoughts. Previously, for example, the US was always seen as kind of AAA, risk-free, stable. And so, when there were times of economic uncertainty, people actually viewed US government bonds as a safe haven.
Yeah.
And so all across, the maturities of the US debt, you saw people, buying 30 years, 40 years. Obviously, the 10-year was the bellwether. That's the most liquid, part of US government borrowings.
Any reason it's 10 years the bellwether?
Well, it's where you've got the right balance of risk and return, but it's also not too long dated. It's where the market focuses on it. So previously, when there was less of a concern about whether governments could actually pay back their debt, in times of economic uncertainty, actually yields fell, right? Because people were buying that as a risk-free asset.
Yeah.
Right. Now we're in a different world where people are focusing on the amount of debt that Western and G7 countries have. And so, longer dated securities present more risk. That's why in Japan, for example, there is what we call a steepening in the curve, where, the rates at the further end, i.e. the longer maturities, are rising more than at the short end, the near term.
Okay. And it's the literal, as if you're drawing a line from the short end to the long end.
Yeah.
That's the steepening is.
It's like a hill incline getting larger, effectively. Yeah.
And what it's essentially, when people talk about a steepening of the yield curve, what is that in layman's terms?
Well, it basically shows that there is higher risk and higher rates, higher cost of borrowing, for the longer maturities.
Because of the concerns about the sustainability.
Yeah, that's the environment we are in now, where the focus is on government debt sustainability, yes.
Right. And how do we rank the concerns amongst countries?
Well, I mean, obviously there's a lot of concern on the US because it's the largest market for government debt. It's the biggest by far, and the most liquid. So that's what everyone really looks at. Then you've obviously, the UK tends to follow the US somewhat, because the economies and, the policies tend to, or at least from a monetary perspective, tend to be aligned. Japan is also a very interesting one. So obviously, as you know, a lot of hedge fund investors have been borrowing from Japan.
This is the
yen carry trade.
Next
Exactly.
sort of stage, isn't it? So,
Yeah.
and that, of course, we saw last year in August. We saw a little snapshot of what might be to come.
Yeah.
So yeah, run us through the carry trade.
Yeah, so effectively, government lending rates or government central bank rates are, have been historically over the last kind of, 10, 15 years near towards zero, and so what hedge funds have been doing, particularly in the US, is borrowing from Japan, at effectively, zero, and then using that to invest in the US stock market or other areas where they see a higher return. So it's basically kind of, they see it as a free lunch, a free way to kind of make money. But obviously, if rates start to rise, currencies move against you, then that can cause, your borrowings to suddenly become expensive. You might have more margin calls because, your positions are underwater as well.
Let's just run through what that actually means. So I'm a Japanese bank.
Yep.
And you're a hedge fund.
Yep.
Right. So I've got, how much do you want to borrow?
Well, if I'm a US hedge fund, probably, as much as I can.
Yeah, just give me it all. So, right, I'll lend you 10 million.
Yep.
So what interest rate would you pay me for that 10 million? So you're saying roughly zero.
Well, it has to be a lot lower than what I would have to pay if I was taking it out in the US, for example. Right. And so obviously, with rates in Japan towards the zero end, then like I'm kind of, as long as it's, far enough away from, say, the 5% that's in the, I might have to pay in the US to a bank to get leverage there. If it's close to zero, if it's
but
zero,
generally
one,
it's been 1%.
1%, yeah.
But then you have to take that and change the currency, don't you?
Yeah.
There you go. So there's your 10 million. So you borrowed at 1%, but then you've done an FX currency trade at 145.
Yeah.
So what? So do you hedge that currency position, or do you leave that at risk as well?
Well, I mean, I think the smart ones would do some hedging, but I would imagine that there are a lot who haven't, because they've had the mindset, well, it's stayed there for so long, I'm only going to borrow for the next couple of years, while the stock market goes up, and then I'll unwind it when I'm out of profit. That's just generally the mindset. So not everybody is hedging that risk. And, if you don't hedge that risk, obviously, if the currency moves against you, or, short-term rates in Japan rise significantly. So if you have to roll over your borrowing at the next payment date and suddenly the rates are higher, suddenly your trades, don't look as attractive.
Yeah.
And,
so if we just put that graph up of the yen. So you have essentially, you've taken that 10 million and you've moved it into dollars at 144. So are you hoping the currency goes above 150 or below 140? You want it to go above 150, right?
Well, yeah, you want to kind of make money on the currency as well. You know. So when you have to pay back the yen, you want have more yen to do that effectively.
Okay, so if this starts going the other direction, if the currency goes through 140 on the downside, then you've paid 1% to me, and you've invested to get 5, 6. But if you start to lose 2-3% on the currency, then suddenly the trade doesn't make sense anymore.
Well, that's right. And so then what you can see is, an unwinding of the trade, and what you don't want to see is a mass unwinding, because then suddenly, everyone's position gets worse because, that loss gets magnified.
Yeah. And so what could lead to that unwind, in a, I guess, exacerbate the speed of the unwind?
Well, I think there's a number of different factors. I mean, at the moment, for example, one of the things that I think people are monitoring is the fiscal situation in Japan, right? So obviously, I mean, recently the Japanese government said that their fiscal situation is worse than Greece's. So there's a lot of scrutiny on it. So look, if the fiscal position in Japan actually worsens, so they're not able to keep things stable. I mean, obviously there's a bit of tariff uncertainty, then, rates can rise, central banks rates can rise, especially if there's inflation, from tariffs that they have to deal with. So that can, cause the borrowing rates to increase, which again makes the carry trade less attractive.
Yeah.
And so as the carry trade is less attractive because you have to borrow at higher rates, a greater unwind happens. So that's one thing that people are focused on, And then there's just a number of, other factors related to the US, how is that performing, as a nation? I mean, I guess, that will also feed through into what the exchange rates are. So, you have to watch a number of different angles effectively to see, to see what's happening.
So let's get the Treasury curve up, or at least the numbers. So it's pretty tricky to see. Let me take that. So this is US Treasuries, and we're focused in on the 10s. Well, the 2s, the 10s, and then that 30.
Yep.
Yeah, that 30 back above 5 now.
That's right. Yeah. So yeah, it is. We're now at the highs. I mean, it could continue. I mean, in the US, let's look at what's happening there. So obviously, you've got a number of things which are offsetting, but obviously there's a big bill going through, which people see as potentially, increasing spending or, reducing some of the tax revenue that's collected.
Yeah.
What the Trump administration and DOJ are saying is that they're going to make those savings up from wastage. So Elon's still sticking to his target of 2 trillion, just has to say, he's saying, well, as long as the government lets me do that, I'll find you those 2 trillion. But then you've got obviously Trump, who's looking to, reduce taxes, invest for growth. He's also been helped by some of the deals he's done in the Middle East. So with Saudi, UAE, and Qatar, that's
good place to do business.
Good place to do business. That's going to bring in $1 trillion, of investment into the US economy. So all of these things are kind of, the market's working out how they all offset each other in their thinking. At the moment, the 10-year and the 30-year, the long end, are, the market is baking in a little bit more risk effectively.
Yeah.
There's still uncertainty on the trade side because the trade deals haven't been struck. Even though the US and China seem to have taken the worst case off the table,
yes.
By agreeing an interim deal where the US pays 10% and China pays 30% until the main deal is struck. There's obviously the UK as well. You've got the,
Let's go down to those UK bonds there. 5.5 on the 30-year.
It's getting interesting, huh?
What's breaking point in the US and UK?
Well, at the end of the day, central banks can always, they can always print money. Inflation is the tax on the population, right? So if these rates continue to rise, it's not going to be so much a break problem. It's just a worsening in the amount that, governments will be able to raise from the market, without having to take extraordinary measures. It's the cost.
That interest payment and liability, continues higher and higher.
I think the point is that you will eventually, if you continue this type of, increase in rates over a period of time, it then starts to make the whole model look unsustainable, and that's when you will reach a breaking point. So you kind of can't keep, spending and not being fiscally responsible for an extended period of time. And so basically, as long as they make sensible actions now, and even if it's gradual, that can take things away from, I guess, the breaking point. But certainly something we've got to keep an eye on, because once you start to get above, 4.5 in the 10-year, it starts to become quite difficult for consumers.
Yeah, because suddenly that interest on the net debt payment. So in the middle there with the big sign, like a nuclear sign, as they refinance this year, $7 trillion still to go, I think.
It's a lot, yeah.
At 4.5 or higher, that it suddenly dwarfs the defence money. It dwarfs the social security, and interest on net debt is going to be the highest expenditure of all, isn't it?
That's right.
And as that rises, if the others aren't cut, then this number here, the budget deficit, the 2 trillion becomes 2.5 trillion.
Yes.
3 trillion. So then the national debt goes 38, 39, 40, 45. And then we're in real trouble, aren't we?
Yeah, we are. I mean, the US is the biggest bond market, so everybody is focused on that. If the US doesn't manage its borrowings prudently from here, it will affect everybody else. So, there's a big focus on it. I mean, everybody knows, now very clearly that you got to, try to reduce wasteful spending. A lot of the waste actually in the US is from all areas actually. So, healthcare costs, for example, are rising massively, and that's because the US healthcare system is geared to, creating a continually sick patient so that the pharma companies can make money. I'm just being honest, because that's basically, everyone knows that's what's happening, right? So they've got to sort that out. So that's why the Make America Healthy Again movement is so important, because as soon as Americans start to be healthier, Medicaid and all the other costs associated will come down. The biggest form of spending, which has basically led to the situation in the US, is the war spending. So since 9/11, around 21 trillion has kind of been spent on security, both internally as well as externally, and war funding, etc.
Wow.
And so that's the biggest one. So they got to kind of figure out how to wean the US off of being a kind of a war economy effectively.
Now, how does this all tie into corporate bonds then, which of course you're the expert in?
Yep. So corporate bonds are obviously, very sensitive to movements in central bank rates. So all the risk-free rates that banks can borrow at. So basically, when you see a rise in rates, that also consequently feeds through into yields or returns, and prices that corporate bonds trade at. In the recent last month, what you've actually seen is while government yields have actually kind of at the long end started to rise more significantly, and in the 10-year in the developed countries, high yield, which is the riskier part of the corporate debt structure, has actually performed better. So it's actually gone up a few percent.
Right.
And that's more as a function of the fact that, what drives corporate bonds is not just, rates that you see, central bank rates, but also the perceived economic risks and how that would feed through into the company's performance. So now the recession card seems to be off the table, because trade negotiations seem to be normalizing somewhat. Not there yet, but, people are feeling it's a bit better. Investing in the higher risk corporate bonds, is perceived to be a little bit safer now. So, people be buying back in,
So the tail risk is the bad thing, because you don't want the company to go bust.
Yep.
But you don't really care what happens to the equity, as long as they've got enough money to pay their bonds.
Well, that's exactly right. And even investment grade bonds, which kind of have tended to mimic, how the government bond curve moves, they've stayed more stable at the long end than governments actually, and that's fascinating actually, because so for example, British American Tobacco, which has a 2052 bond, which is traded on our platform, it's got around 30 years, from where we are today. That has actually firmed a little bit in price, so it's gone up a little bit, whereas the 30-year UK government bond has actually gone down in price, and the yields have risen. And so people are looking at things at governments and corporates very differently. I mean, let's take the extreme example. Apple has got a far superior credit rating or credit
Than the government.
Than the U.S. government. I mean, it's very interesting, and that's. The US, I mean, people thought that Moody's downgrading, the US from AAA by a notch was a big thing. But look, the market's already baked this in. I mean, everyone kind of knew it wasn't really there, in reality.
Yeah.
So it's just a bit of catch up. So the market's taken it in its stride, but it's a sign of things to come if we don't fix things.
Yeah. We got a comment on chat there. Andrew McKelvey saying, talking of UK bonds, that Scottish bond proxy SSE up 1.7% on the day on the back in numbers. Does SSE have a corporate bond?
They do actually, yeah. I mean, I think we have one on our site. I haven't looked at it in a while, but I don't know if it's a perpetual maybe. But yeah, they do have bonds.
So
yeah.
a lot of the companies, the sort of big UK companies, have got.
Yeah. Basically, a lot of the FTSE 250, FTSE 350 companies have borrowings as bonds. So investment grade bonds, or sometimes even high yield as well. Like I said, like Ocado, for example, has a high yield bond, 10.5%. Stock's been down. I think last time I looked at it a few weeks ago, it was down 20%. But the bonds were steady, so they made you 10.5%. A lot of the major large caps in the FTSE, have bonds. I mean, obviously the banks have loads of them across the capital structure. And Tesco and all the big, Marks and Spencers, all the big companies, they all have bonds. So, it's very interesting to think about which is going to generate you the most value in the next 5 years.